Hello and welcome to Mommy Dentist and Business Podcast. I'm your host, Dr. Grace Yum. Welcome back, everybody. I know that it's summertime and everyone's busy. Hopefully, you've had some time to unwind and rest and get some summer travel in and be with your friends and family. I know that oftentimes especially coming off of a 4th of July type of weekend, we can sometimes feel, I don't feel like going back to work type of emotions taking place. Or you might say, you know what, it's 4th of July. I'm still going to work anyway and work around it. But whatever you choose, just know that I think I left my brain back in Spain. And I'm also in the thick of World Cup. But we're
Oh,
gonna have to get into that. But I just am
no.
excited. I'm excited to introduce you. Well, reintroduce you. If you're new here and you're listening for the first time, then yes, our guest Travis Slade is new, or maybe you already know him. And I know that he has been a very excellent guest for us, and he has been on the Mommy Dennis show. This isn't his first rodeo. And the information he gave last time had to do with the big, beautiful bill also and how accounting affects not just our dental practices, but our everyday lives. So, welcome back to the show, Travis. And wanted to mention that he is the founder of Uluru Advisors. And I can't wait for you to tell everybody why you've called your firm Uluru, but welcome back.
Thanks for having me, Grace. I'm a big fan of mommy dentists, and I just had a meeting this morning with a
Thank you.
a mom. She had a baby back in January,
Okay.
and I was like, and I was telling her, I was like, I'm sure you know the mommy dentist in business group,
Oh,
and she
yeah.
was like, oh, I haven't heard of them, and I was so mad at her, and I was yelling at her to join the group. It's the best group in the world. You guys are the nice. She's such a nice client too. I'm like, you guys are just the
Oh,
nicest group,
thank
and so I think
you.
every mother should be part of this group. I think it's so
Thank
great.
you. Well, you know what? You let me know after the show what her name is, and I'll make sure she gets a really warm welcome from
Oh yeah,
me.
yeah, I will.
But speaking of, I think, we all kind of attract our energies all attract the right people and the right, just um, businesses and patients and clients. And I think that when you're all kind of in that similar vibe, we all get along, we all trust each other, we all do business together. And I think that's what makes Mommy Dennis unique in that we always want to welcome our experts that we work with and be a community together, where it's not just the mommy dentist in a vacuum, but we rely on people like you to help us do what we need to do. So, without me babbling, I would love for you to please tell everyone who's new here a little bit about yourself, your history, what you do, and how you got to where you are today.
Yeah. So the quick story is I studied accounting and I thought it was dumb. Like, I'm not going to be an accountant. So I did finance, way better, out of school. But I had a brother who's a dentist, and he was always asking me business questions. And I decided to go work for my brother. And my eyes were opened to the world of being a practice owner and all the decisions, financial decisions you have to make,
Mm-hmm.
let alone clinical decisions and
Right.
everything else, right? And that was what put this bee in my bonnet. My brother had made some bad choices, and he made some bad financial decisions. But he didn't really have anyone guiding him. He had no guidance and no one in his corner helping him. And so this bee got put in my bonnet of these practice owners need help making good financial decisions, and who better than the accountant that they have to hire anyways to file their taxes that
Mhm.
has access to all their data. So I've been spending about a decade doing only dental accounting, and I love it. And
Mhm.
I love accounting. It has a stereotype, accounting though, of just being a boring and bland industry,
Well,
and
so does dentistry.
well, accountants make dentists look really sexy. I'll just say that.
Oh, okay.
Yeah.
That's
Um,
that's when we need the sound engineer to insert like a funny sound, like what?
No, I don't know. Maybe I'm just I'm leaning into the accounting stereotype more than it is. But accounting has stereotype of being boring and bland. And so a couple years ago when I started my own company, I wanted to, be a fresh voice for practice owners, for dentists, and accounting is boring and bland, just like the Australian outback. If you've ever been to the Australian outback, it's very boring and bland. I've become semi-obsessed with the Australian outback, for different reasons. It's a long story, but if you were to ever go, Grace, to the Australian outback, you're like, where do I go? It's like, what
Yeah.
is even the outback? It's like just big, massive, boring. Well, there's one destination worth going to in the outback. It's this massive rock that comes out of the ground and it's beautiful. And it's like, if you're going to go to the Australian outback and not the steakhouse, you're going to go to this rock. And
Okay.
that rock is called Uluru. Think of it like it rhymes with kangaroo. It's an Australian word. Uluru, kangaroo. And that is the name I chose for my company because it's like symbolic of what I wanted to represent in the accounting space. I wanted to stand out and be a destination worth going to. I just wish it was an easier word to like
Uluru.
say,
It's so hard to
Uluru.
say. Well, I thought
Kangaroo,
you were
think
gonna be
kangaroo.
well,
Uluru.
no, like I thought what you were gonna say was that you, in addition to being like a destination that people wanted to go to, I thought you were gonna be like, yeah, I wanted to be the rock
Yeah. Well, I did. Yeah, I want to be the rock of accounting. Yeah, exactly. Of dental accounting.
of dental
No, so
accounting.
that's my story.
Solid.
And so we're a young firm, a young accounting firm. We have a growing team, and I love what we do. There's just
Mm.
so much opportunity to help practice
Mhm.
owners and answer the question of how
Mm.
much money do I make, right? Like it's such a simple question and such a hard answer. There's so many things like that I just love helping owners with. So.
Amazing. So I have to ask you, what's the difference between someone who's a tax accountant and someone who's a tax attorney, and why do tax professionals sometimes disagree? But before I go into that, let's go back to accountant, right? There's accounting, but then I is there such a thing as a tax accountant versus just a general accountant?
Um, yes. So like accounting's broad, in the same respect of like medicine, right? Like you can be a doctor of mental health and not know anything about, tooth decay. So
Mhm.
accounting's a very broad space.
Mm,
Most people when they like I'm a CPA and most people when you say I'm a CPA, they're like, "Oh, I need help with my taxes." There's like 70% of CPAs don't do anything with taxes. So there's like big public firms,
mhm,
Fortune 500, they have auditors and accounting
mhm.
departments and internal CPAs. Like, so there's a whole slew of accounting that doesn't touch tax. So
Okay.
now
So
yeah, anyways.
okay, so then you are specifically a tax accountant? Is that what you do?
Yeah, so my emphasis is in tax. Yeah. So
Okay.
it's not like a licensure or anything. It's just like
Focus.
a focus. Yeah.
Okay, so then we need to then decipher, because this is like a really great topic because a lot of people want to obviously save on taxes, right? Like the whole like we're always trying to find ways to save on taxes. So how would you say there's a difference to, again, for our listeners who may not know, because majority are dentists, right? They know teeth. Then what's the difference between a tax accountant and tax attorney?
Okay, so what I think is important, the whole so I feel like I was raised by CPAs
Okay.
and it wasn't until I was like a CPA for 7 years that I realized there's this whole other world of tax law, let's say,
Okay. Okay.
um, the tax code, and there's it almost sounds like sketchy the way I'm saying this, but
Mhm.
it's there's when someone says like I got asked a question last week by one of my clients. He's like, "Hey, I'm buying a treadmill for my house. Um, is that can I write that off?" And he's like, I thought there was some tax law. I can write that off, right? It's like, I get questions like that all the time.
Okay.
And it's like, it's a pretty confident no, on a personal treadmill at your house, like how is that going to have a business purpose? But my mind has now shifted to there's this spectrum of uh, deductibility. So anytime, you like a lot of people want to think in black and white. Like, can I write that
Hmm.
on? Can I do this? Can I do that for taxes? And what most people don't realize is there is a spectrum and there are probabilities, and the IRS has rules around, do you think it's more likely than not? And they have all this verbiage about like how to navigate the spectrum of uncertainty with
Hmm.
taxes. And it is not as black and white as we sometimes think it is. Now, the CPA world where I was raised, CPAs are very busy and I love CPA. I'm a CPA. I love CPAs. Like they work hard, they work their butt off. And but they also don't have a lot of time to fool
Hmm.
around with your imagination, right? Like, hey,
Right.
what if I did this cute little tax thing with, my dog and we took it around to schools to market and can we write this off? Like your CPA is just like, no, it's not deductible. I don't have time for this, right? But an attorney, a tax attorney is somebody who's not in the weeds of filing taxes, and they're always thinking like, well, there's this code section about, some deductible thing, and can I make an argument for you? And is there like, if it got challenged, would we be able to win? Like, I think that would be like a 50% chance of winning and 50%. So like, yeah, like we could take this stance, and maybe it's a little aggressive. Um, but I think what most people don't realize is
Hmm.
that whether it's a CPA or tax attorney, there's people that will try to argue that there is an argument for most things, and that there is a anytime you ask like, can I write this off? It's not always just a black and white thing. So like, some things are definitely higher on the spectrum. So if I was to say like, if there's a spectrum of 0 to 100, and 0 is clearly illegal and 100 is clearly legal, if you own a dental practice and you want to buy a boat, we would probably put that like close to 0. Like most practice owners don't need a ski boat for their family on the weekends, right? Like we're not going to write that off through the business. I know people who have done that, and I don't think it's a good idea, right? Like that's pretty far on the spectrum. Now, on the other end of the spectrum, if you're a practice owner and you're buying supplies from Henry Schein and you're paying assistants and you're paying for rent for your office, that's basically 100%. Like clearly those things are business related. But somewhere in between are things like your home office or meals or business travel, hiring your kids, right? A business vehicle, even business vehicles are not, I would not put out 100%, right? But some people get used to them, and they put them closer to the 100. But the example I always use are massages, right? So like um, most dentists complain about neck pain and back pain, and probably would benefit for their work by getting a regular massage, right? So if they're getting let's say, a massage every other week, can they write that off? Well, that now we're going on to the spectrum of deductibility, and it's not at 100%, but it's not at 0%, and there's kind of an argument to be made. Like, I don't like massages. I don't like when people touch me, right? But if I was a dentist, I would probably be getting one because I feel like it would help like my longevity, and it could be a business, help me with my business. So there's an argument for like deducting your massages, but it's not black and white. Like there's a good chance if you got an auditor, they would disallow it. So you would kind of have to fight that, and you could fight it. You could go through the
Hmm.
tax courts, and but like at the end of the day, like we're talking about $2,000 a year maybe, right? So it's like
Yeah.
it's low stakes, so maybe you take it, feeling like it really has a business use, but it might get disallowed or something. So I think the thesis, and I'll shut up. But there's this spectrum, and sometimes we want things in the tax code to be black and white, and
Right.
some CPAs think will communicate like it's black and white. Like, clearly you shouldn't write off a massage. But, there's arguments to be made for it, I think.
Right.
I don't know if
Right.
you'll win, but like you could argue it if you wanted to.
I think as I'm listening to you and you hear these things and you hear of people being risk adverse or risk takers and those who want to argue for it, you think about like the black and gray and the white, um, and you take a risk, right? You take a risk of being audited or then then you kind of have to think to yourself like is that $2,000 worth the risk of an audit and is it really going to move the needle on saving on taxes, right? Cuz like I think that's where the strategy comes into play where you're kind of like, well, let's look at your whole, you know, picture of finances and where are we really going to effectively move the needle.
Uh-oh. Grace.
hi.
Hey Grace. Sorry.
Right.
I don't know if that was on my end.
I think that was on my end. Like the lights flickered for a minute and like everything just shut down. So my assistant at my house just said that the Wi like all over the house, the electricity went on and off or off and on, whatever. And so I just basically connected my computer to my phone hotspot to get Wi-Fi connection because my Wi-Fi is now suddenly down, which has never happened. So
Uh, I'm
we will
sorry.
continue. It's okay. I just wanted to keep going.
Yeah.
All right, so we'll just pick up where we left off.
Is it still, did it, oh yeah, it's recording. Okay. Yeah.
Yeah,
Great.
it's recording.
Okay.
So, okay. So I'm going to go back to what we were saying. I'm going to start over. So it sounds like you were saying, Travis, that one has to assess their risk level and assess like what they're really going to write off and what they're not going to write off. And because things are black and white or gray or whatever, you and your clients have to assess what's worth the write off or trying or attempting, and then know that what are the consequences, like you could get possibly audited, etc. But I think from a perspective, it's like my perspective would be if I came to you, I'd be like, hey, I have like a whole laundry list of things that I want to write off, and then you would maybe advise me like, hey, this isn't worth the risk, this is maybe we'll do this, we won't do this, but come up with the plan, because you kind of need can't go for everything, and you want to, for me at least, I want to spend time on like what's going to move the needle and
Yeah.
what's really going to save me a lot versus what's going to save me pennies, right? And then if I'm trying to save pennies and then suddenly get audited because of that, it's just not worth it.
Yeah. I will say this. I don't think usually something like a massage, let's say, isn't going to flag an audit. And what generally happens is it's if you get audited for just at random and then that comes up, that's when it would be an issue.
Mm-hmm.
So again, there's a whole spectrum of personalities out there. So I don't want to
Mm-hmm.
like make any generalizations, but there's a lot of what I've seen in people that are more aggressive is they'll take some aggressive positions. Like you could probably find a dentist out there who's deducted their massages for 20 years and they've never been audited. And so they imply that they must be doing it right, right? But
Mm-hmm.
the IRS is like very much understaffed. They had a bunch of layoffs. They don't have great resources. It's really easy to do something wrong and not get caught.
Mm-hmm.
And there's a lot of that going on. And again, people just imply that they must be doing it right if the IRS didn't say anything. And that's not the case. So that's like one end of the spectrum. And there are a lot of things that really you could take a position on that would not flag the IRS if you're running it through the practice and you're trying to defend it. Like the IRS
Right.
isn't going to catch a lot of those things. Now there are other things that could, so you want to be careful. But I think what like that, so that's one in the spectrum of people being aggressive and getting away with it and thinking that it's okay and it
Mm-hmm.
necessarily isn't. But then there's also people who are like, they think that they're wanting to be black and white and taking zero risk, but they still have a business car, which I don't think a business car is like I would do it if I had it, and most of my practice owners do, but it's not 100% guaranteed. Like you have to defend your business miles, and you have to have auto logs, and most people don't have auto logs, and usually you need to have more than 50% usage to get the best benefits, and you might have to be aggressive on your mileage. So there's people that have a car and they think that it's like bulletproof, but it might not be, right? And so it's I think just understanding that there's a risk of or there's a spectrum of deductibility, there's a spectrum of risk.
Mm-hmm.
And I see things on Instagram of, people talking about things that I'm like, man, do they really are people really able to like sift through this and understand that, yes, you can take this position, but it's a little bit risky. So
Mm-hmm.
there are a few things that I would use as my North Stars if I was a practice owner. And we talk
Mm-hmm.
about this with our clients too. But
Mm-hmm.
um, if you want to write something off, um, you have to be able to defend it. So can I say that this has a clear business purpose, right?
Mhm,
And just think logically. Like don't try to
mhm,
get cute and creative on like, oh, like just think like, would a logical person say that this is a like another term is an ordinary and necessary expense for a dental practice owner? And just think through that. And again, like a massage, like you could argue it's ordinary and necessary, right? Like I think.
mhm.
But like a ski boat, like you don't need that as a practice owner, right? So like there's definitely things to think through. The other thing that I've noticed a lot, and I noticed this during the employee retention credit during COVID, is there's a lot of well, um, like there's some advanced tax strategies, and maybe we'll talk about them in this podcast. But I've noticed in certain people that are promoting tax strategies are not tax attorneys or CPAs. They're just investors.
Mm,
And there's a lot of tax stuff out there, and some of it is, you could take if you understand the risk, but I would be cautious on who is giving you information. And there is a lot of information from people that are not trained in the tax code and tax law. And
mhm.
there's a difference between, in a lot of tax strategies, they have these referral commissions. So like people
Sure.
who like give them to you, they get like 6%
Yeah.
commission on it and stuff. And so again, it doesn't mean you can't do this if you vet it, but you just have to be cautious on the spectrum of tax code. And I think it's something that I learned. It took me years to learn even as a CPA. And I think for a lot of practice owners, it can get confusing for especially if you're somebody who's in a high tax bracket, you get creamed by the tax code and you're like, there has to be some better way. And you get some Instagram ad that's like, we can eliminate all your taxes. And you might be able to, and there are strategies out there, but you just have to be cautious as you proceed.
Yeah.
Yeah.
So, like you had mentioned, oh, well, you might be able to get away with it or whatever. And that's probably luck of the draw, right? Like, my sister's a lawyer, and like 5 or 6 years ago, and she has her own law firm in San Diego, and she got audited, and it was like a nightmare because it's like, who has time for this, you
Yeah.
know? And they found nothing wrong, but it's just a pain in the butt. Like
Yeah.
there's nothing wrong and she could prove everything, but it's like it's just the amount of time and energy that goes into it, that that stress, the time, the money, and it's just not worth it. But on another note, I'm just bringing up a scenario. Let's just say you were that doctor who for 20 years wrote off the massages, wrote off the car, and then you sold your practice. Can the IRS go after you after the fact? Is there like some
So
time in which they can't anymore?
So it's a 3-year statute of limitations. So if it's been 3 years since you filed your tax return, then they can't come after you unless it's deemed as fraud. So
Ugh,
which is
okay.
which is like a broad definition, and actually spent a lot of time with some tax attorneys trying to define that over some other things, and
Mhm,
it seems like the IRS can just pull that wild card whenever they want, but I would say they're probably not going to pull that wild card unless there's some big money at stake. So
mm,
for the massages, like again, that's not even going to flag the IRS by itself,
mhm, mhm,
and it's not like the IRS, like because the IRS looks at their own ROI. So like if they're going to do an audit, they have to spend time on it, and they need to be able to feel confident that they can get um, a certain amount of money back, and they're probably not going to go after someone like that.
mm, mm.
Um,
Okay. Just curious.
yeah, yeah. I mean,
I'm
again, I
asking for a friend.
no, I think there's things. Sometimes I talk to practice owners, and I'm like, I feel like you can take a little bit more risk on like your meals and some of the things. Like some people are really scared. And it's like I think you could take a little bit more risk on some people, for some people. Um, and then other people need to dial it way back. It's like, man, you're being way
Yeah.
too aggressive. And I have my own biases, and everyone has their own biases too. So it just depends. But you do want to make sure like whatever you're doing, you're getting good advice from a professional, and things are well reasoned. But just know that it's not as black and white as maybe we want it to be.
Sure. But what are the biggest tax saving opportunities then for practice owners that maybe that they overlook?
Yeah, so like I would say things that like I have like a tier one, let's say. And,
Hmm.
and these are things that aren't really going to flag the IRS by themselves, and I think are pretty easy to defend, if not like 100% defensible. So these are things like an automobile. Like we do automobiles for most of our clients on the books, and the way you do those can really be beneficial if you
Hmm.
do it the right way.
Hmm.
Um, and that can be a big deduction. So automobiles, kids on payroll. So that's another one. Like you have to have, a use for your kids and they have to, have a real purpose. It's harder to do that for an infant than for an 8 year
Right,
old, right? Like,
right.
doesn't mean you can't put an infant on payroll, but again, that's now you're leaning more on that spectrum, a little bit higher risk, right?
Right.
Um, but so kids on payroll is a really great one. Retirement plans, right? Retirement plans is at like 100, like it's very defensible. But there's where people maybe miss the mark is how it's structured and the type of retirement plans that are out there. Um, your home office. So there's a lot of people have heard of the Augusta rule
Yep.
in your home office. Like that's a really great one. Um, there's something everyone should be doing if you live in a state that has income taxes called the pass-through entity tax
Yep.
deduction, PTET. Every state is different, but you want to make sure and maximize that. And that is kind of quirky, but requires some planning. Um, and then like HSA. So, if you're in a high deductible health insurance plan, like maxing your HSA, that's not a huge one. But it's a good one for what it's worth. And then when the time is right, so you have to you this one all the Patterson reps love, right? Year-end purchases. But the situation has to be right. Like if
Sure.
you're right on the cusp of a tax bracket and you need to buy some equipment anyways, it could be beneficial to get some year-end purchases to kind of bump into a lower tax bracket and get um, good benefits. So all of those things are like very defensible. Like maybe some of them are a little bit on the spectrum, but like they require a little bit of planning. But I think most practice owners should be doing all of those things.
Well, it sounds standard. Like it sounds like these are standard strategies. Like you're not gonna, it sounds like standard, structured, right? So as long as it's structured and defensible, we're in the clear. And then those are the things that you would propose for dental practice owners.
So yes, so that's like tier one stuff. For sure, everyone should be looking at those. And we always do an analysis on our clients like where we like do their tax projection before these things and then after these things. And with this list combined, like you will always save 20 to like 40,000 in taxes by doing these things. Like it depends, let's
Yeah,
say 10 to 40,000. And
right.
and so that's like, this just requires organization and planning and execution. And there's some defensibility that you need to be prepared for on auto miles or kids on payroll or things like that. Uh, but I think everyone should be doing that. Now, there's another tier of strategies where you're getting more on the spectrum, and a little bit riskier, but I still think are defensible. And and if you find the right firm, you can take a position. So like a common one is R&D credits. So
Yes.
that's
I
that.
was just thinking that.
Okay.
Yeah.
So, and that's had a lot of changes that's happened over the years. But there's a lot of really reputable firms out there for the R&D credit. Like there's been a lot of activity in that space.
Mm.
And I think there's some great firms. Now, I don't know if I was a GP and like the argument for R&D I don't know, should we talk about what this credit? It basically is like it was a credit that was created in 1984 to incentivize the United States to like innovate. And
Hmm.
so if you're creating an innovative product in the United States, the federal taxes will give you a credit. And that's kind of the premise of it. And so like there's a lot of manufacturing companies that get a huge R&D credit. There's a lot of software companies that like make new software products. They get a huge R&D credit. Um, and it seeped into dentistry over the years. It's been around a long time, but I feel like it didn't seep into dentistry until the last decade or so. And
Yeah. No, and I know of people, some of my colleagues who use it and do it
yes,
in their offices.
yes.
And that was probably about right before COVID. So like in 2019, a lot of my colleagues were, but they were actually like they had their own private practice, but they were also professors at the school and things like that. So
So I mean, they're like if you are like making like a new like numbing agent and you really are like making a new product, then it's easy. But what where some people like, and this is tax attorneys, so now we're talking tax attorneys. They've looked at the law and how it's worded and the verbiage and you have to be creating something new and there has to be some uncertainty. And they're like, well, an orthodontist, every smile is new and there's uncertainty if that smile is going to be perfect,
it's true. It's true.
right?
I
So
agree. Yeah.
so orthodontics is a big space where the R&D credit, a lot of orthodontists get it. And again, these orthodontists, they want to know like, can I do the R&D credit? Like, give me a yes or no answer. And it's like, well, like if you're willing to take some risk, yes, like, but if you want absolute certainty, then no, like you probably shouldn't do it. So it just depends. But you will also want to have a good team that helps you with the R&D credit that
Hmm.
crafts good arguments for it
Hmm.
and has good verbiage and will help you with it in a case of an audit.
Hmm.
So
Hmm.
doing something like the R&D, that is something that could flag an audit. Like that's an easy thing. You have to file a separate form on your tax return. So the
Hmm.
IRS can very easily see if you're getting it. And so they can match, a dentist's business code because every business that files a tax return, they have a business code. So they can say, okay, it's a dental practice and they're getting the R&D credit. And they can just flag all of them if they wanted to, right? So, um, but it's something like I have some clients that do it. I have a client that was so the argument on GPs usually is if you have an in-house milling unit, every you have to do the design
Right.
in-house and you have to
Right.
mill it, and there's uncertainty and creativity and all this kind of stuff with each crown that you mill. Um, so anyways, there's an argument there, but it's just up to you on if you think it
Yeah.
applies to your practice and if you think
Right.
you can defend it.
Right.
Um,
It's all about the nuances. It's all about the details. And
very much so. Like and
yeah.
so like another one, like so I'll just list a few. Like there's cost segregation.
Yep.
So if you own real
Real
estate,
estate.
this one I would put with like a high degree. Like I don't know if this is crazy risky. Doesn't mean it doesn't have any risk, but like it's very common to do a cost segregation study
Hmm.
if you own real estate. It helps you
Yeah.
accelerate your deductions.
Actions. Yeah.
Um, there's a short-term rental loophole, also a
Hmm.
real estate thing but those have been getting audited a lot.
Hmm.
Um,
Well, the STR, I feel like, has been a lot of, I would say, social media attention. And
correct.
yeah, there's been a
There's
lot of
there's
that.
been a lot of attention on that one, and it's a good one for like if you're a W-2 high income W-2 earner where you
Hmm.
otherwise don't have anywhere to like write off losses or
Right.
something.
Right. You don't have
Um,
like a corporation to like fold it in.
correct. I really don't recommend it for practice owners unless they already have a bunch of rentals and they're
Right.
passionate about the space. But I
Right.
wouldn't like go out of my way to do something like that
Right.
personally. But there's like again, that's a great example of like there are some great accounting firms that are really good at the short-term rental stuff, and that's all they do, and it's legit, but their clients still get audited, and they have to defend their client.
Right.
Um, so it just depends. A couple others I'll just mention briefly. Like there's a lot of deductions around oil and gas investments that you may hear about. That's a little bit more on the advanced side. And then there's appreciated charitable donations. That's one I've been hearing a lot about. Um, Anyways, all of this stuff has an opportunity to have big tax savings, but it does come with more risk. And so you just want to, it's like a specialist. Like you want to go in with a specialist, you
Yeah.
want to have the right firm, and then you have to understand that regardless, no matter what you do, there will be some risk associated with it.
Absolutely. I mean, it's, everyone has a different risk tolerance, but I also think it depends on the level of wealth you've accumulated as well, and like where you are in the tax bracket and what you have accessibility to. And those are all conversations that you have to have with a specialist in that area. Um, but I'm going to move on to the next question, which is about Trump accounts, because again, those have been getting a lot of attention as well. Should parents be considering them? And I think for our listeners who aren't aware of what the Trump accounts are, we'll talk about that. But should parents consider them, and how do they compare to other plans like the Education 529s, Roth, etc.?
Yeah. So the the one big beautiful bill was passed on July 4th, 2025, and it added this new type of savings accounts specifically for kids, and they're called Trump accounts. That's the actual name. So if you don't like Trump, there's no other name that we can call them. Um, but um, but they went live on July 4th, 2026, which just recently happened. So um,
Yesterday.
uh, yeah, well, last
Oh,
week, July
okay.
4th.
Oh, did you say 6th or the 4th?
Oh, I meant July 4th, 4th of
Oh,
July.
okay. Okay, you said 6. I was like, that's
Oh,
yesterday. Okay, so
oh,
4th of July.
July
Okay.
4th. Yeah, my mind is mush. So on July 4th, 2026, you can now open up a Trump account for your child. And here's what it is. It's basically an IRA account. So it's it grows tax deferred. So you can put money into the account, you put $1,000 in, and it grows forever, and the kid doesn't pay any taxes as it grows. But
Mm-hmm.
then when they pull it out in retirement, then they pay taxes on it. Um, and it has its advantages. They have a couple things that why um, our mommy dentist might want to do it. The first thing is if your child is born between 2025 and 2028, then you automatically get $1,000 into that account. So the government funds $1,000 into that account for you. And on the website, they say, if you don't touch it, if you have a kid and they get $1,000 and you don't touch it until the kid's 55 years old, they should have about $250,000 into that account. And so it's kind of a no-brainer. Like if you had a kid last year or through 2028, you should set up a Trump account. And you can just go online, you can just Google open a Trump account, and it will actually take you to an app on your phone. So you probably want to do it on your phone,
Mm-hmm.
and you download this app. I haven't gone, they actually just changed this last week. So, um, but yeah, it's a legit thing, and you'll set up an account, and then eventually they'll create the account for you, and they'll put the money into it. Um, so that's a reason people would want to do it. Another reason, and there's a lot of details that are still getting ironed out, but an employer can put up to $2,500 into a Trump account for a kid, and it's a business deduction for the employer.
Okay.
So you could put $2,500 into your kid's account and it potentially become a business deduction. Those details are still, there's a few things that I think still need to get ironed out.
Mhm.
So for those reasons, a lot of the listeners will probably want to create a Trump account at some point for their kids. Um,
Okay.
they don't have to like, there's not a ton of urgency on it. And we need some of the details to be worked out. But there are like a lot of limitations. Like the most you can put into a Trump account each year is $5,000. There's only one bank that you can open the account at. So like if you're a big Charles Schwab person or Fidelity person, like we don't know if they're going to have Trump accounts yet. Right now, there's only
Mhm.
one bank. And you cannot touch the money. Whatever you put in there, you cannot touch before the kid is 18 years old. So you're like locked out of the account. Whereas other accounts you could dip into if you needed
Right.
to for some reason.
So then question, what about children that are not born between 2025 and 2028?
Yeah. So all my kids are in that bucket.
Right.
So I could still open up an account for them. So I can open up account for the kid. As long as they're a minor, you can open up the account. And then I have a business. So if my business puts money into their account, it can be a tax deduction. So I'm still wanting to do it for my kids, at least for the business portion.
Right.
Um, but there's a few, like I've tried to start the process, but there's a few details that we need more clarification on
Okay.
from them. But it's something to keep on your radar of um, of keeping it in there.
So
But
so then like if you were kids, okay, so you're gonna hypothetically open up accounts for your kids and they're on your payroll and therefore you as a business can put the 2500 in there.
so that's what I'm still trying to get clarity on. Do they have to be on payroll or does their parent have to be on payroll? Because when it was initially um, like most kids are not on payroll.
Right.
And part of the reason of this Trump account is most kids cannot have an IRA because you have to be an
Right.
employee to open an
Wait.
IRA.
Right.
And
Right.
so it was a way to help these kids open up an IRA like account without
Sure.
being an employee. So
Sure.
I'm pretty sure it's if the parent is employed, but I'm still working through the details myself because I'm trying to do it on my
Yeah.
own kids. But
Yeah.
it's something like there's definitely going to be a way to be able to put it on your kids and get a tax deduction for it because that was part of the original legislation.
Right. Yeah, see, that's the catch-all, you know what I mean? Like, the catch is, like, you know, can
So it
can you do it as but anyway, I'm sure like
it's in the devil in so like what'll happen. This is like I mean this happened a ton with COVID is like Congress will write legislation. Like they'll write a law, like, hey, we want this. But then, like, how it's executed oftentimes is left up to the IRS to like tell us how it will actually get implemented and executed,
mhm,
and
mhm,
then or like through follow-up stuff. So there's always this process of like clarification that happens in
clarification.
execution, and that's kind of where we're at with the Trump accounts.
Okay, so we just wait, but f in the meantime, though, if you have employees with kids, you can that's clear. So if, like, you have a dental practice, your office manager has, like, an 8-year-old, you can open up a Trump or that parent would open up a Trump account, but you as a business can put money into that child's Trump account
And get a deduction for it. Yeah. So
and
you
get a
probably,
deduction.
as if you're own a practice, you probably don't, you're not going to go out of your way to like fund your hygienist kids account. You could, but you could do it for your own kids because you're most likely employed at your own practice
Right.
if you're an S corp. So um, it, I should like. There's more clarification coming on this on like the
Sure.
actual execution, but keep it on your radar.
Yeah.
That's the theme I would say is like
Yeah.
for sure if you have a kid, in 2025 to 2028, but otherwise keep it on your radar as something to look forward to it before the end of the year.
Perfect. All right. So, speaking of kids and what we want to do for them as wonderful parents we are, as one does, the next question is what are like the smartest ways to start building wealth from them early? And how can practice ownership create those opportunities? I mean, you were talking about employing them and then feeding that, like putting money into their Roth, but earlier in the podcast. But are there other ways?
Yeah, so I think zooming out a little bit, like it's actually as a practice owner, if you want to start putting money away for your kids, you're actually in a really good place to do that. But zooming out, there are four general accounts that you can set up for your kids. And we just because we've been getting asked, all of our clients have been asking us about these Trump accounts. That's why it's like fresh on my mind. We put a calculator thing on our website that's
Mhm.
anyone can use, and it shows you the four accounts, and you can play around with it. You can say, okay, I'm going to put $2,000 a year into this account, and then it depends what you want. Like, why are you saving money for your kids? Is it for their college? Is it for a wedding? Like something, random? Or is it for their retirement? So the Trump accounts were really designed to help incentivize saving for your kids' retirement,
Mm-hmm.
which is not really like top of mind for most people. Like we're trying to save for our own retirement, right? Most practice
Mm-hmm.
owners.
Mm-hmm.
But it's so everyone has different goals on why they are saving for their kids. But I really like a kind of a multi approach to kids savings. So if you're a practice owner, there is oftentimes, depends on the age of the kid and stuff, but there's oftentimes a justification of um, having your kid as an employee and putting them on payroll. So that's the thing, we talked about that a little bit. So if your kid is on payroll, now they are eligible to fund a Roth IRA. And Roth IRAs are awesome. There's a lot of benefits to Roth IRAs. There's no deduction when you put the money in, but it grows tax free. You can take it out tax free in retirement, and you can even take it out for education purposes. A certain amount you can take out for education. You can also take out whatever money you put in penalty free. So if you put in 20,000 into a Roth IRA, you can always take out 20,000 and then the growth you just have to wait till retirement. So Roths are great. So
Mm-hmm.
let's say like this year you can pay your kid $15,000, $16,000. Let's say you pay your kid $15,000. The first thing I would do I would put 7,500 into a Roth IRA for my kid.
Well, that's
And
the max.
that's the max you can do in a Roth, correct? But now that they're getting wages, um, you can put that money into the Roth. Now you want to pay your kids $16,000 because if you pay them more than that, then they'll owe taxes. But if it's
Tax.
less than 16,000, they actually are in a low enough tax bracket where they don't owe any income taxes. So if you pay your kids 16,000 and then you get 7,500 into the Roth IRA, you paid some payroll taxes in the process, but you still have some money in their account. So that you could now fund either you could do some into the Trump account, you could do some into a 529 savings account. But I really like the fourth option, which is an UGMA or an UTMA account. It's basically a brokerage account. So, like, think of an investment account at Charles Schwab, and you can invest it in SpaceX or some mutual funds or whatever else, whatever you want to invest it in. It's a taxable account, so they'll pay taxes on the earnings, but they can use, it's better than a savings account. Like, it'll grow with the market, and they
Yeah.
can use the money on whatever they want. So, like a
Mhm.
wedding or big random expenses
Mhm.
that they might have later in life, buying a first house or something like that would be a good account for things like that. There's some nuances to that, and we're getting into like financial planning stuff, but you can I would fund a Roth IRA for sure, and
Mhm.
then either put a little bit into a 529 plan for education, and then a
Yep.
little bit into an UGMA, and kind of have each of these buckets growing, which each can be used for different purposes.
And all pre-tax dollars.
Correct, because you paid them on payroll. Yeah,
Yeah.
exactly.
So, like, it's a benefit. I mean, like, I have friends, but their kids are in high school, so it would make more sense that they would earn the 16 grand for the year because
Yeah.
they're in high school and they actually would work those hours, right? And like mine are little still. So, like, for my kids, I'm not paying them the full 16 because it really isn't defensible. So like I'm trying to obviously pay my kids off of my payroll to accordance of what is defensible, right? And so um I just think that it's really interesting to see because like my friends who have high schoolers, they're using some of that money to like pay for their club soccer, like, they're teaching them how to use money wisely, right? Like, they're using it as a lesson, like, "This is your bank account. Now you're gonna pay for your own gas if you don't have an electric car," or, like, "Now you're gonna pay for your own cell phone bill." And so now they're, like, 17, right? They're working up until like, they're working their way into learning these life lessons before they go off to college. And so for me, that's, like, an eye-opening thing because it's, like, it's such good practice for them, right? Like, to start training them how to be in control of their money.
Yeah.
Yeah.
Yeah, no, I mean, if you have a kid on payroll, in order to do it the right way, the money needs to go into a bank account that's in their name. Like you can't just
Right.
move the money into your own bank account. So it,
Right.
it needs to go into an account in their name.
Right.
Now,
Right.
you could charge them rent of 16,000 and move the money back, right? But there is an opportunity to your point, Grace, to like, especially for the older kids, to like start teaching money management early on. And
Yeah.
I do this thing where I like the UGMA account. I'll do like just $1,000 every birthday to my kids' UGMA. And then they come into my office and I'm like, let's pick out like what stocks do you want to buy, you
That's
know? And they're
awesome.
like I can buy Target or all these random ones.
Yeah.
And they can't buy Nito stocks or some of the things they ask are kind of funny, but
That's so cute.
uh
The Nito. Oh God, that's like the death of me. Those things. Have you had one explode in your house?
I'm not a fan. We actually don't have that many, and the kids just set them up on their dresser, so I'm glad.
Okay.
But I've
Oh,
heard horror stories,
oh
but they're
yeah.
always sold out. Like they always want to go places and they're never there. I don't know.
Oh my God. But anyway, thank you so much for all of this information that is so useful. Listeners, I think this is all real sound advice, all things that I can attest to. I'm gonna go look into the UGMA account because I haven't done that. Um, so I will look into that. Thank you for that.
Yeah, cool.
So, okay, my last question, because you're a business owner and a dad, what is your number one piece of advice on how you are balancing both being a professional and, not just a dad, but your personal
Yeah, I have nothing to say. I feel like I am
life?
I try. My wife is not a morning person. I'm a morning person. So I usually do the mornings with the kids. I
Okay,
I have a home office, so I work from home and I work a lot, but I feel like I still have these pockets a day where I'm I help the kids in the morning and then I always have dinner with the kids before I
perfect.
go work at night if I do. But and so I feel like I'm here, but like, it's hard when you have a business and your mind is like consumed by the business. And
Mm.
I had my son, I'm looking it up right now. My son wrote me a note, and this was my son's name is Milo, and this is a story about George. So it's a fictional story,
Oh,
allegedly.
okay,
This is
allegedly.
I'll end with this. Once upon a time, a kid named George wanted to go to the Lakers game, but his dad said the tickets were too much money, like $200. So he saved for years and years and years, and he had $200, so he paid for two tickets, one for him and one for his dad. And then on the next page, it says in all caps, but his dad was busy, frowny
Oh,
face.
oh no! Oh no! Oh my God, that is the cutest thing ever. But
And
did he like present that to you or like,
we were like, it was in a fun place. Like we were like right like he was at the dinner table and he was writing it, but he spelled busy BISY too. It's like pretty cute note. But
oh,
it broke my heart. I was like, oh my gosh, we
yeah.
ended up going to a Lakers game like
Okay.
the next week. So
Okay.
he definitely got his message across,
Yeah.
um
Oh,
but
that's
I'm no one. I'm just that's my theme to say I'm no one to
oh,
reach
stop.
any advice. So,
Oh, stop. No, it's hard. No, as you said, it's all consuming, right? Like it's hard to like draw the line, especially if you work at home because there's like your home is your work and sometimes it's hard to turn that all off. But my kids will say to me like, "Mom, stop doom scrolling," or like they'll take my phone and hide it from me.
yeah.
So they have their ways of communicating with you. Like, we want your attention.
Yeah.
And I think as busy parents, sometimes we need that reminder. So, well, thank you for sharing that story. It was fantastic. And if anybody wants to find Uluru, what is the best way to do so?
Yeah. So, my email is Travis at gouluru.com. It's GOULURU. Bunch of U's in there. Um,
A lot of
and
vowels.
yeah, always happy to answer any questions. And you can follow me on social media as well. Travis Slade .cpa is my handle.
Perfect.
So
Well, thanks.
thank you.
Thank you for sharing this valuable information. And guys, get started planning. Stop putting it off because as busy professionals, we often put things off. And with this, you don't want to put it off. So get on it, and we will see you at our next podcast episode. And our social summit is this September in Georgetown, Washington, D.C. I just went last week. And our hotel is fabulous. We're at the Fairmont, 7-minute walking, and it goes straight into M Street where all the shops, restaurants are. And the hotel is gorgeous. They've done a lot of new renovations. The rooms are renovated and new. And we're going to have a great time. And honestly, we want to see you there. Come and join us. It's fantastic. And you don't have to be a mom dentist. You can, some of our mommies bring their daughters or associates. It's really for all women dentists. So if you're listening and you want to attend, come and do so or reach out to me. On that note, thank you all and have a great rest of the week. Take care now. Thanks, Travis.
Thanks. We'll see you.